Hi guys, this is Hugh Hendry. As you know, or perhaps you don't, but I was responsible. I managed, I launched, I was the chief donut for the Eclectica Macro Fund between 2002 and late 2017, a 15-year period. And this is the third installment of Confessions, where I take you back in time. I take you back to the bottom of the bear market of the great TMT crash, which had started in late 1999. And so here we are, prices are down 80 odd percent in terms of these technology names. And I have launched a macro fund. And it is now December. And for the month of December, I'm pleased to say that I staged something of a comeback in true Eclectica style. What is that style? That style typically would have meant we had a profile which was long volatility on those kind of pivot moments when there was a panic in the market. So if markets were down hard, markets were down rapidly, I would typically have hoped that that would have been a factor or a catalyst which would have spurred a positive P&L within our portfolio. So December was one of those months. The British stock market, the FTSE All Share, was down the best part of 7% as we approached the end of calendar year 2002 and as I approached the end of my first quarter as a hedge fund manager. I'd ask you to remember that hedge funds really they're just like high end. Some might even question the high end, but they're like restaurants. It's a high risk endeavor. Lots of restaurants fail. The majority fail in the first 12 months. And that's equally true of hedge funds. And the fabulous returns, part of that owes itself to survivorship bias to those who make it through that first year. Clearly talent is one of the factors. But for me back then, I wasn't sure. I mean, I wasn't going to be judged at the end of 2002, but at the end of 2003 for sure, if I didn't get my ass off the floor and start producing a kind of decent positive return, especially given our positioning at the bottom of a bear market, then I probably would not be recording this today. But as it was, with the market down 7%, the Eclectica fund was up the best part of 2 or 1.8. So kind of like the mirror image of the first month when we began. If memory serves me right, and I'm probably making this up, but it felt like the market, I think we were down like 4.8 and the market was up 7. I'm probably overstating that, but these returns in December allowed me to close out the quarter being down 3. Not fatal, but and with the market up 1.5%. So you're running a kind of long vol, running an idiosyncratic macro portfolio and using this all equity, high vol, indeed short vol equity index, if you will. So, we're not comparing apples with apples. However, that said, things are kind of beginning to change. I'm sensing, clearly nothing like making all about what I want to say. It's all about the market really kind of getting pushed lower, and you discover that actually you're making money. And so my pecker, if you will, is up. And I'm talking about a commodity speculator paradise. Now, that's kind of where we went to, but this was still a rather speculative term. But I'm feeling more confident. And in the opening commentary, which of course I've passed on, you can we make available the underlying commentary if you visit Hugh Hendry Official. You will see the underlying written paper that we sent out to clients. But we were noting that in the calendar year of 2002, we're kind of, the economy in America is recovering, but you've got to remember, this was the first radicalization. We'd gone from Fed funds rates of 6.5% all the way down to 1.25%. That was a big wow factor. So monetary policy was very much in its ascendancy. Fiscal policy, they had done a 1% GDP expansion. Nothing, kind of like in today's world. And they were coming back towards, as the year approached its end, they were coming back with the ambition to spend another 1%, but still kind of nothing. And the dollar, given that big tsunami-like cut in rates, had weakened and had fallen the best part of 10%. So we kind of know there's a lot of liquidity in the system. And like I was saying, it's very unfair, the monetary system. Like, money rarely flows to where it's most required, which would be to say distressed businesses and distressed households. And instead, that liquidity that's coming out of this faulty plumbing system, if you will, is going to cons like me, and is going to things which are inflating, which are in asset price uptrends. And back then, that would be soft commodities. That would be the FX of commodity nations like New Zealand, like Australia. That would be the euro versus the dollar. And that was soon to be the Eclectica fund. You also see kind of my improved sentiment, so to speak, and like feeling a little bit more confident in myself, because we're beginning to have some risk on the portfolio. We're running 120 gross, with 80% of NEV being dedicated to the longs, and just under 40% to the shorts. When I look at the short names, really can't make no rhyme or reason to why we had those names. I guess when I look at the long shorts, you could kind of say what was appropriate is that we had something of an RV trade. We were long commodity cyclicals, and we were short large cap dependable staples. I'd probably be adopting that position today as well. But the big change is the gold boys are in town. The gold shares have entered into the Eclectica hedge fund, and we've got the blue chip names. So we've got 5% in Newmont, we have 5% in Goldfields, slightly larger position in Ashanti. We've got a 6.5% position in the CRB Commodity Futures Index. And then talk about Pecker being up. We have 5% in Durban Deep to the uninitiated. In Latin, there is a term, a nomen is a nomen, which is to say, what is it to say? It's to say that the name tells you something. There's always a giveaway, if you will. And what was the name telling us here? This was a profoundly deep South African mine. I don't think I ever met it. All I heard was it's a very deep mine. It was pretty much all the time unprofitable. But if you were to kind of like multiply the gold price by 2 or 3x, the marginal gain in profitability would be stark. And so a stock which was probably on you would discover that you were kind of on 2x, nothing like doubling the gold price, but on 2x, you were probably buying this on a 50% plus earnings yield. And you'd have thought that'd be unsustainable, and therefore the price would move higher. But I want to say, this is from a kid who was schooled by this very Edinburgh-based, very, very diligent, very, very professional, very, very dour, analytical house. We at the time we controlled risk by investing in superior companies, and here I was chasing returns, buying very much inferior companies. But I guess I must have read this in one of the Soros books. Once you have a narrative, you got to kind of barbell into the best companies in case you're wrong, and the very worst companies in case you're right. And that always stuck with me. So 120% gross equity. And remember, really the qualifying factor is people always think their shorts are going to go, they're going to make money from their shorts when they lose money from their longs, and therefore they're diversified, kind of market neutral. In my experience, there was always those moments where you lost money on both sides. And so really it was better to look at your equity book as being just 1.2 times you were geared long, if you will. It's a very pessimistic way, but it's kind of for someone who was seeking tenure, for someone that wanted to last, for someone that wanted the opportunity to come back and do this thing again and again and again, I found thinking about it in those terms was helpful. So 120, and then we've got 60% in currencies. Again, pretty much, in the equity line, we are, like I said, long cyclicals, short staples. In the currency, we are long commodity producing nations like Australia and New Zealand, predominantly New Zealand at this point, and probably short those FX crosses where it's the country like the yen where they're having to predominantly import commodities, and so the terms of trade are against them. But 60%, so it sounds large, it sounds like it's half of our gross equity book, but currency pairs, the daily price volatility is very, very low, certainly in comparison with equities, or it was in an era of quantitative easing. The volatility of all risk assets has fallen, but that said, a 60% allocation to FX on a risk-adjusted basis would probably have been no more than about 20-25% of NEV. To put that into some context, a 5% position in Durban Deep would be like a 25, 30, if not bigger, NEV position in a currency swap line. So we had, it takes a lot of swagger at the bottom of the market to have 5% of your NEV invested in Durban Deep. Now, of course, turning to the stock insight. Stock insight, really, I don't want to spend too much time on. In fact, I think I've got no more than a minute or so. But we had Barry Callebaut. Barry Callebaut is very much, it's like Amsterdam Commodities. It's another very, very solid, boring business, cyclical business, a business with an uneven progression in earnings because they were always struggling with what's called the refining ratio. These guys are the world's largest producer of cocoa, and therefore, if you're there tonight ordering your dark chocolate, most likely the cocoa came from these guys out of West Africa. But with that refining margin, your earnings every cycle would be much higher, but like trying to nail it to the quarterly earnings, a bit like a gaming company, not a gaming company, a bit like a betting company perhaps, erratic, and therefore the stock was afforded an earnings yield of, I want to say 15%, or a price earnings ratio of 6. For me, I have to say I'm a little shamefaced because I was typically there was a setup. What I've done is not only have I shown you the fact that I think this was a 9-bagger from where we bought it, but our entry point was odd for me because typically I was buying new highs, I was buying uptrends, and here I am doing the opposite. I got really very lucky with this stock because the technicals, or these voices in my head that I allude to, were really not giving me a message. It was more, I think, the intelligence team from my analytical department that was saying, hey, look, you want commodities, you want exposure to soft commodities. This Barry Callebaut is a very, very sound, very, very cheap company which will deliver. So what I've done is, to shame myself, I've shown you how it looked, not today looking back, but at the time. And you can see, I think the only defense for my purchase was that it had broken its downtrend. But this was not the strongest base point from a technical perspective for me to launch an investment. And maybe that's why, because here I think last week Amsterdam Commodities was a 20-bagger. This is a 9-bagger, and you're like, but where you kind of made 8% after fees compound over 15 years. So maybe there's a little bit of risk. We might touch upon this. I'm sure we'll touch upon this at another stage. But my good friend Steve Drobny, he christened me the Plasticine Macro trader. I would kind of break my narrative down into hundreds of little positions like a centipede. So I always had feet in the game, if you will, but I could expand. My position was Mali, but I could expand and I could take down. I could change my mind. I could chop these positions out because they were kind of small. But of course, the smallness perhaps prevented me from harvesting bigger gains, ? In my head. And then finally, when I think about this period and how here we are again entering the third act in modern markets in 2020, I would reflect on 2020 vision, but let me give you a little kind of anecdote from, it wasn't 2002, it was probably 2005, 2006, and I had been asked to present at a Russian investors forum which followed close on the heels of Davos. and I had, like in typical fashion, had made a name for myself probably by being rude, but I'd been invited to this VIP party overlooking Red Square, and there, would you believe, is Mark Faber, Jimmie Rogers, Nassim Taleb. I mean, it was just an astonishing evening, and I was bumping off them. I had been on a panel with Nassim, who was not interested. I was like, hey, Nassim, I love the book. He's like, go away. Okay. Jimmie Rogers, we've always had a love-hate relationship. He's that kind of guy. And then Mark, the most oversexed financial brain in the world. And so I would have Nassim after the presentation we did. He kind of liked me. He'd come up and he'd say, what is your name again? And I say, Hugh Hendry. He's like, Hendrix. And he'd walk away, and then he'd come back eating, and he'd say, tell me again, what is your name? As if we'd never had that conversation. I would be sitting with Jimmie and with all these kind of kids. I mean, Jimmie's a god, and Jim, and he was, again, he'd been on the commodity market, and he would open up his suit jacket and he'd bring out like a silver coin and say, you should buy silver. And in his trouser pocket, he'd bring out a sachet of sugar and say, sugar's going to the moon. And then in another pocket, he had gold. I'm like, Jimmie, you're like, really? What else? What have you got in your shoes? So that was funny. And Mark was just, Mark Faber always just looks like all that's missing is the white cat sitting on his lap. But he left shortly afterwards, I think, to pursue other endeavors in the night. So funny times. The bull market was fast approaching, and my losses were recovering relative to the market. So I hope you will join me next week when we move into the new calendar year, the year of 2003, which ultimately, despite some hiccups, ends in being a great triumph and perhaps secures my tenure for a little while. So thank you very much for listening, and goodbye from St. Bart's.